My name is Brian Balfour. I'm the Senior Vice President of Research at the John Locke Foundation. The Locke Foundation is a state-based public policy organization located in Raleigh. We focus on all sorts of issues from fiscal policy to education policy to election issues and energy issues, etc., primarily at the state level. My background is in economics. I've spent several years doing fiscal policy analysis before rising up to my current position. And I also had the privilege of authoring a textbook called Economics in Action that's been used in econ courses here at the Thales Academy. So today, the tantalizing title of the discussion, The Creature from Jekyll Island, the workings of the Federal Reserve. So we'll find out in a few minutes a little bit of the story behind that title about Jekyll Island. But really just wanted to kind of discuss today, this morning, the Federal Reserve, kind of how it works, and especially in today's climate of rising prices, to tie in the workings of the Federal Reserve, their role in inflation, as well as just kind of an overview of how that works and just the Federal Reserve's outsized role in the economy in general. So this gentleman here, some of you may have seen him on the news. His name is Jerome Powell. He is the chairman of the board of the Federal Reserve. And I'm showing his picture up there just because I wanted to start off with just a short little story or anecdote. And some of you may recall, if you follow this things closely, but on August 26th, that gentleman, Mr. Powell, he made a speech, just making a speech declaring the Federal Reserve's strong commitment to fighting inflation. Obviously, I'm sure you all are painfully aware of what's going on in terms of the rising cost of living and prices all along the board. And so during this speech, Powell affirmed that the Federal Reserve will, quote, use our tools forcefully to attack inflation, and he expects the central banks to continue raising interest rates in a way that he said, quote, will cause some pain to the U.S. economy. So why do I bring this up? Because just that day alone, after those comments that Chairman Powell made, the Dow Jones on the stock market dropped 3% that day. Doesn't necessarily sound like a lot, but to put that in perspective, that's one day. 3% in one day. What does that mean? That's just over $1 trillion in value. And so recall, this is Dow Jones, so this is people's 401ks, their investments, retirement investments, and so forth. So just in one day, from one man, that man just giving a speech, $1 trillion of value in assets of people's retirement funds and savings was wiped out. I would say that's quite a bit of power. We can have discussions about who wields the most power over the economy, Bill Gates, Jeff Bezos, the president, Congress, etc. I would say that man, Jerome Powell, and the Federal Reserve arguably wield the most power and influence over shaping our economy. So, the Federal Reserve. Let's just do kind of a quick overview. What is it? A little bit, a couple minutes on their history, the founding. So the Federal Reserve is considered the nation's central bank, and important to note that Congress maintains oversight over the Federal Reserve, and running it is a seven-member board of governors, chaired, of course, by Mr. Powell, as I mentioned. And the governing body that's located in Washington, D.C., and these governors, board of governors, are nominated by the president and confirmed by their positions by the U.S. Senate. So it's a lot of political control and oversight over who's running the board, and in turn running the Federal Reserve Board is appointed by Congress. So there's 12 district banks, and they serve as the banker's bank for the banks in their district. And by that I'll mean the main functions as the banker's bank, the 12 district banks. They basically provide the same kind of services that your bank provides to you, except they're providing those services to your banks in their district. services like holding accounts, checking accounts for the banks on the Federal Reserve books. They make loans to the banks. They engage in check clearing services. Also, they engage in a lot of regulatory monitoring of the banks, so that's an important role of the Federal Reserve as well. But that last one is really the last bullet point there, monetary policy. That's really what we're going to focus on the talk today. And I mentioned there the Federal Open Market Committee. That's the body that conducts monetary policy. So we'll be focusing on that, the FOMC, focusing on that quite a bit today. So a little bit of history pre-Federal Reserve. So the current central bank, known as the Federal Reserve, was not the first attempt at a central bank in the U.S. The first one took place in 1791, and that was founded upon the urging of Alexander Hamilton, who was the treasurer at the time, of course. And Hamilton had some ambitious ideas about how to solve some of the financial and economic challenges facing that, at the time, very, very young nation of ours. And he felt that a central bank would be pretty critical and pretty helpful at that time. And at that time, the first central bank acted as primarily just as a fiscal agent for the federal government, also provided banking services to the public, but importantly, it did not engage in monetary policy. It was the first bank had a 20-year charter, and after that 20-year charter expired, Congress decided not to renew it. So that was the lifespan of the first central bank, was just that first 20 years. So then they went back to the drawing board, and the Second Bank of the United States was signed into law by James Madison in 1816. This was inspired in no small part because of a lot of the debts that the U.S. government took on because of the War of 1812. And so supporters of the notion of creating another central bank felt that that would be really helpful in helping to pay off the debts from the War of 1812. But however, Congress voted to shutter. It was obviously controversial. Not everyone agreed that it was the best solution or an effective solution. So 2 years prior to the 20-year charter expiring in 1834, Congress voted to shutter that national bank, which then brings us to the creation of the Federal Reserve, which was created in 1913 by the Federal Reserve Act signed by then President Woodrow Wilson. But importantly, the genesis of the idea can be traced to a secret meeting in 1910. This is where Jekyll Island comes into play, and the title of this talk. And that creature from Jekyll Island, that's also the name of a book, a pretty well-known book. What Winston was actually telling me that you can't even find it on Amazon, but a book by that name, The Creature from Jekyll Island, a book documenting this process of the creation of the Federal Reserve and kind of how this came together. So what are we talking about? So on November 10th, 1910, 6 men met on Jekyll Island to draw up plans to create a new central bank. And this process was heavily shaped and informed and influenced by big banking influences. The meeting was arranged by J.P. Morgan, yes, that J.P. Morgan of the investment bank notoriety. And the attendees included Henry Davison, who was a partner at J.P. Morgan, Frank Vanderlip, who was a partner at a Rockefeller-owned National City Bank, Paul Warburg, who was a partner in a large investment bank, also Nelson Aldrich, who was a senator and member of the Senate Finance Committee, along with his assistant, and A. Piatt Andrew, who was then Assistant Treasury Secretary. So you can see a lot of influence by big bankers. J.P. Morgan, Nelson Rockefeller had their fingerprints all over this meeting. And interestingly enough, this, as I mentioned, this was a secret meeting. Word of it didn't really get out until the 1930s when some of the attendees started discussing it. One of them, I believe, wrote in his memoirs and talked about this meeting, which really kind of opened the floodgates on people learning more about that meeting. So Jekyll Island is an island off of Georgia, just by the way. So what were some of the at least stated concerns of these folks that brought them together to discuss creating a new central bank? Concern over financial panics. There had been some panics over the previous several years. And what happened in the kind of decentralized banking system at that time during banking panics, money was spread out in the bank vaults across the country. There was no real centralized oversight or depository at that time. So when panic hit, people started panicking and withdrawing their money from banks and causing all sorts of failures among banks because of that. Money was kind of frozen. It couldn't really move around to where it was needed most. There was no central bank that was authorized to generate new money, and I'll talk shortly about how the Federal Reserve now does that, creating new money. So those are some of the stated reasons and incentives for them to come. But one thing, and this was a quote from one of the books from the gentleman from there talking about, and this is really to the heart of what I think was behind their motivation, is they talked about the inelastic supply of currency and limited supplies of gold also contributed to long and painful deflation. So they were concerned that first phrase there, I think, is really key. Inelastic supply of currency. So what does that mean? That means, as I mentioned a minute ago, there was no means to create new money, to inject new money into the system, and they found that troubling. And I'll explain why, not necessarily, and it wasn't necessarily altruistic motives they had in mind. So what were some of the first steps that happened after that, after the Federal Reserve was created? Well, they centralized banking reserves at the Fed, talking about those regional banks that I mentioned a minute ago. They made it much easier, and much easier to create new money. I'll get to that in a minute. That has to do with the monetary policy that they developed. They cut in half the reserve requirements of banks, allowing for more rapid inflation. Now, I'll talk about reserve requirements in a couple minutes, kind of explain that in more detail and why reducing reserve requirements would help facilitate inflation, more money circulating in the economy. So with the creation of the Federal Reserve, we have to kind of pause for a minute and ask ourselves, who benefits, So how do banks make money? Well, to the large extent, they make money through loans. They lend money out to people wanting to borrow money to finance their car purchase, take out a mortgage, businesses wanting to finance their business expansion, etc. So the reserve requirement, so what does that mean? Basically, so when you make a deposit at your bank, say $1,000, the bank doesn't hold all of that $1,000, in their vaults, in their reserves. There's a reserve requirement, and typically, and currently, and traditionally, reserve requirement has been 10%. So what that means is the bank only needs to hold 10% of all the deposits, actually have them available for people to withdraw. The rest of that 90%, they try to use as much as that to lend out to people, because that's how they make money. They lend out money, they charge interest on the loans, that's how they make money. So basically, for example, and we can see how this process can spread out throughout the economy, throughout the banking system, and really generate a lot of new money circulating around. So say, for example, you deposit $1,000 at your bank, right? So they don't hold all $1,000 at that bank. They'll hold $100 of that to meet that 10% reserve requirement. The other $900 they'll lend out. So say, for example, they lend it out to that $900 to Mr. Smith to buy a used car. So now Mr. Smith has this $900. He uses it to buy a used car. Now that used car dealer has $900 that they put in their bank account. So now their bank has $900. They only need to keep 10%. They only need to keep $90 in their vault. So now that bank can lend out the other $810. So now someone else receives that $810 as a loan. That $810 gets deposited in that bank. That bank only needs to keep the 10%, the $81, they can lend out the rest. So you can kind of see, as this cycles through the economy, that initial deposit of $1,000, if there's a 10% reserve requirement, has the potential to turn into $10,000 circulating through the economy with all this money being lent out to make all these purchases. And so I think you could see, like, when the Federal Reserve was created and they reduced those reserve requirements, so say, for example, you could see if the reserve requirement was lowered from 10% to 5%, that means even more money during this process, this money multiplier process, can be created. So with that, more money supply means more loans, which means more interest payments for the banks, which means greater bank profits. So who's benefiting? And recall what I was saying a minute ago at Jekyll Island, the big bankers were concerned with inelastic money supply. So they wanted more, it to be easier for the central bank, for the Federal Reserve, to create more money and initiate this process. So I think it's easy to make the argument that the big bankers really had their bottom line in mind when they were creating the federal bank. They wanted to fight against the quote-unquote inelastic money supply, and you could see, especially with this money multiplier impact, how an increase in the money supply really aids the big banks' bottom line. So how does this process work? I'll try to cover that in terms of the Federal Reserve creating more money and impacting the money supply. So you'll see, and we've seen this several times now over the last this year, headlines about the Federal Reserve raising interest rates to fight inflation. So what does that mean when the Fed takes action to raise, or lower for that matter, interest rates? So this has to do with the monetary policy tools that I was talking about a minute ago. So I already went over the reserve requirement. But the federal funds rate, that's going to come into play. This is really what's being targeted by the Federal Reserve. So the Federal Reserve doesn't actually directly change the rates. They don't go in and just punch numbers in on a computer, and interest rates now are higher and lower automatically. They engage in activity that will alter rates. So if you pay close attention to those headlines about the Federal Reserve trying to change rates, they'll talk about the Federal Reserve as targeting a lower or higher interest rate. So how do they do it? They do it largely through open market operations. So getting back to the reserve requirements, right? So oftentimes banks, when they settle up at the end of the day, they'll see, oh gosh, we don't have enough money on hand to fulfill our reserve requirements. And then other banks will have more than enough. So what will happen at the end of the day? Some banks, the banks that are short, they'll borrow money from the banks that have extra. Very short-term loans, oftentimes even just overnight. Sometimes you'll hear reports about overnight loans. But that's the federal funds rate, right? The federal funds rate is the rate that these banks charge each other, the interest that they charge each other on these very short-term, often overnight loans, in order to so the banks can fulfill their reserve requirements. So how does the Federal Reserve then, what activities do they engage in to impact the interest rates? So to raise rates, the Fed will sell assets. So what does that mean? So the Federal Reserve has a lot of assets on its books. They'll have money, they'll have cash on hand, they'll also own a lot of especially government treasuries, government bonds, right? So to raise the rates, if they want to impact interest rates and try to raise them, what the Feds will do is they'll sell some of their assets, some of their bonds to these banks. So what happens then is that the banks will purchase these assets, and so therefore the banks the banks are exchanging their cash for government securities, in large part, treasuries, bonds. So now the banks have less cash on hand to lend out. So simple supply and demand tells you that a diminished supply, so they'll have fewer loanable funds now. They'll have less cash on hand to lend out, so then that's going to lead to higher interest rates. There's going to be fewer loanable funds out there in the system, so banks are going to tend to charge higher interest rates because of the diminished supply of available funds. Conversely, to lower rates, the Federal Reserve will buy assets off the banks. So what they'll do is they'll go to the banks and say, hey, we'll buy $1 million worth of your treasury bonds that you own, of those assets. And so the Federal Reserve, but here's the kicker, when the Federal Reserve buys those assets, they're not buying it, they're not using money on their books, on their ledger to buy those assets. They're creating money out of thin air to buy those assets. And that's how money creation happens. So, for example, if you buy something, if you spend $500 to buy a TV, for example, you're taking $500 from your account and giving that $500 to the store. Federal Reserve doesn't do that. The Federal Reserve, when they buy their assets from the banks, they don't take $1 million from their account. They just credit the banks with the $1 million. They just generate the zeros out of thin air. And then the banks now have that, and that counts as cash. And so now the banks have, in this case, for example, $1 million now to lend out, and that money multiplier process starts up with that $1 million. That can turn into $10 million circulating in the economy. So that's really critical to understand. And I mean, just trying to a brief overview of the time I'm allowed to try to give an understanding of just kind of how this process works. In the old days, the Federal Reserve used to have actually, would print up new dollar bills, on the printing presses and send it to the banks. But now it's just done all digitally. So at any rate, so when the Fed does that and they're buying the assets from the banks, so now the banks have more cash on hand. So the banks then are going to tend to lower interest rates because they have more money to lend, so they need to entice more borrowers, so you're going to attract more borrowers with lower interest rates. So just kind of a quick overview of the main tool the Federal Reserve uses to impact interest rates. And yeah, like I said, it does so buying money created out of thin air. And then another thing that the Federal Reserve engages in that it impacts the money supply is what's called monetizing the debt. And what that means is when they engage in deficit spending, meaning when the government is trying to spend more money than they have, they issue these debt instruments. So most of them are typically sold to the public or investment firms making interest. But when there's not enough interest or when deficits are particularly high, the Federal Reserve will digitally print up more money to buy some of those debt instruments, buy some of those treasuries from the government using new money. So that is another thing or another action that can manipulate and increase the money supply that the Federal Reserve engages in. So we kind of have this two-headed coin here. So efforts to lower interest rates that I talked about a minute ago, and then this monetizing the debt process, those will serve to increase the money supply. And then, okay, so yeah, that's just a reminder. The federal funds rate is the interest rate commercial banks charge each other for those short-term loans. Key idea. So, okay, this slide made it in. So here is the federal funds target rate. This means this is the Federal Reserve targeting that federal funds rate, that the banks charge each other on those short-term overnight loans. So you can see this is starting back in January 1st of 2009. You can see they're basically targeting, and this is, of course, some perspective coming out of the Great Recession, and this was the primary tool in their toolkit the Federal Reserve was using to try to bring the economy back up out from the Great Recession was extremely low interest rates, lots of money creation, try to get money flowing through the economy, and get businesses and consumers borrowing money again to get things stimulated. So you can see in 2009 all the way up through 2016, I mean, those were historically low targeted interest rates. And then you can see in 2016 it starts climbing up and kind of on a staircase pattern there for the next couple years. They start trying to gradually raise interest rates because they recognize all that money circulating in the economy is going to be causing price inflation. So right there around 2019 going into 2020, and then you see the big drop off in 2020. That was in response to the COVID economic lockdowns. So they go back to their default strategy of ultra low interest rates and printing up more money, creating more money to try to combat the negative impacts of the economic impacts of the COVID lockdowns. So then you can see it was pretty low there. They held them low for a couple of years, and then at the end of the chart there, in the basically last year, there's been several rate hikes. Again, Federal Reserve trying to bring those rates back up again to tamp down inflation. And just a note here on inflation. So, inflation is a monetary phenomenon. I know it's been in the news a lot, obviously, over the last year. There's a lot of attempted explanations for why prices are rising. But as Milton Friedman once famously said, inflation is everywhere and always a monetary phenomenon. It's really just more money circulating in the economy, chasing goods and services. So when you have, again, supply and demand, when you have a sharply rising number of dollars chasing goods and services, there's more dollars that are going to be used to purchase each one of those goods and services. So that's when we see prices rising across the board. Let's see. Okay, so now just to put this into a little bit of context, so the money supply, this is the chart of the money supply, and this is, real quick, you'll notice it's the M1. There's different measures of the money supply, but this is the most basic one, M1, and this measures the most liquid forms of money in the economy, such as actual cash circulating, checkable or demand deposits, and they still list traveler's checks. I don't know if anyone even remembers those anymore, but the Fed still lists those as part of the M1 money supply. I doubt that's a very large percentage of it. But it's basically the money that's most readily available to spend, when folks are spending money. There's broader measures that include other savings and time deposits and CD, certificates of deposits, money market funds, things like that. But I focused on M1 here because, again, it's the most liquid, it's the most readily available form of money for folks to spend. So I showed you in the last chart, the Federal Reserve, starting in 2009, trying to keep interest rates really low. So this is the result with the money supply. You can see, so a steady increase. So starting in January 2008, the total money supply was about just under $1.4 trillion. 12 years later, after this steady supply of historically, the result of the Fed trying to maintain historically low interest rates, by January 2020, money supply had climbed to just about $4 trillion. So the money supply nearly tripled in 14 years. But then you'll see in 2020, it just goes berserk, for lack of a better term. From January 2020, and for the next 2 years to January 2022, it went from basically about $4 trillion to $20.5 trillion. It more than quintupled in 2 years. So if you want to know why your grocery bill has exploded in the last year, you want to know why gas, blew up to $4 a gallon lately and has dipped and is now heading back up again. Housing prices have inflated so much. Rents are going up. That's why. This is completely unprecedented. We're talking, now keep in mind again, just in 2008, the total entire money supply was less than $1.5 trillion. It increased in 2 years, these last 2 years, by $17 trillion. That's just the increase in the last 2 years. This is money circulating through the economy. And so a lot of that, of course, not all of it was just the Fed's attempt to keep interest rates low. The federal government engaged in ambitious spending, COVID relief funds and stimulus spending, etc. Significant federal government deficits, nearly $6 trillion in deficit spending alone in 2020 and 2021. So much of that debt, much of that deficit spending was monetized, as we mentioned earlier, monetized by the Federal Reserve with just new money creation. So you can imagine, close to $6 trillion In monetizing the debt, again, think about that money multiplier. Once that hits the economy and that starts circulating through the economy, how much that can grow into. So if you want to understand, again, like I said, if you want to understand why prices are rising across the board, just have a look at that chart. And so now I wanted to mention a couple things kind of in closing, and then I'll be happy to answer any questions that you all have. So the Federal Reserve, it's often talked about the Federal Reserve has a dual mandate. Those two items are maximizing sustainable employment and price stability. So this chart here, this starts at 1913, the creation of the Federal Reserve, and this charts the consumer price index over time up to current day. And you can see that basically this is measuring the value of the dollar and how the value of a dollar has diminished in the 100+ years since the Federal Reserve. And essentially, what do I have here? The dollar has lost nearly 97% of its value since the Federal Reserve was created in 1913, 97%. So the buying power of a dollar in 1913 is equivalent to just under 3.5 cents today. So price stability, I think that would be, I would argue the Federal Reserve is failing drastically in that part of their mandate, price stability. You can see, and also I think it's important, like I say on the slide here, this harms savers. So if you're trying to save money, why are you going to save money when you can see from this chart, and you know that money is going to be worth less when you go to spend it. So it's really harmful for savers, and for a healthy economy, and even for a healthy household budgeting, savings is important. It's critical. You want to, but when you look at this chart and you understand, look at this chart and understand, I mean, this really goes against savings, because your savings is going to diminish in value over time. So it really harms savers. It really sends negative incentives for people throughout the economy to disincentivize savings. And then one more point I wanted to make, these inflationary policies, they increase wealth inequality. And here's why. So we have the easy money, low interest environments. They inflate the stock market and real estate bubbles in particular. I'm sure if you've been paying attention, going back from the, recovering from the Great Recession, I showed you the low interest rates, all the money creation, stock market has inflated. And then in the last couple years, outside of the COVID shutdowns, stock market it's now being burst, but it was had a really inflated a stock market bubble, real estate bubble as well. So for example, the Dow Jones from 2009 to 2020, pre-COVID, roughly tripled in just those 11 years. Housing prices, after bottoming out at the end of 2010, have more than doubled. They're up 130% up to date. And as I mentioned, that bubble really inflating. It's up 38% in the last 2 years alone, housing prices. Those are starting to cool off because of the Federal Reserve, working to bring the interest rates up again. But so who benefits by these bubbles? These easy, created by the easy money, the low interest rate environments, all the money creation. As you might suspect, most of the benefits accrue to the wealthy investor class. We have the wealthy people; they derive most of their money. Income, revenue, et cetera, from their investments, while the rest of us, the working folks and working class and the working poor, they derive their income obviously from their work, from their labor, from their paychecks. So just to kind of shed a little perspective on this, the wealthiest 1% own 53% of all the stocks. Wealthiest 10% own 89% of all the stocks. So that big, those big bubbles being inflated in the stock market, that's who's receiving most of those gains. The working class, lower income households, they own very little stocks, and as thus are not benefiting. Housing, from 2010 to 2020, about 71% of the increase in housing wealth was gained by high income households. Makes sense, $1 million homes, $2 million homes, the more expensive homes, they're much more scarce than the quote-unquote average-sized home. So that scarcity is going to help to particularly drive up prices on those more expensive homes owned by the wealthy. So as I mentioned, so the wealthy, they're benefiting greatly from that, because that's where they're getting their money. That's where they're accumulating more wealth. Middle and lower class rely on labor income. So the money creation inflates asset bubbles that benefit the wealthy. The working class and poor, however, oftentimes lack the bargaining power to raise their wages to keep up with the rising prices, right? So the wealthy, they're benefiting from their investments being inflated. Meanwhile, the cost of living, for groceries and gas and utility bills and so forth, it's going up. It might bother the wealthy a little bit. It's not really going to put too much of a dent in their household budgets. But it's the working class. It's lower incomes people that are really going to be struggling as the price of those things increase. So, for example, inflation, measured inflation over the past year, about 8.5%. However, average wages only increased by 5.3%. So if you're primarily getting your income from wages, you are worse off. Your wages are not they're not keeping up with the increasing price of living. So we have this process unfolding over time. You can see how that really exacerbates wealth inequality. The wealthy benefiting from the inflationary environment with the asset classes increasing, and the working class really struggling and falling behind. So yeah, I wanted to leave you with that, and just kind of, my goal was really kind of give you an overview of the Federal Reserve, talk about their role in inflation, provide a little bit of insight into the mechanics of how they attempt to manipulate interest rates, so you can have a little more background, when you see the headlines coming out about the Federal Reserve targeting interest rates, and then just the impact it has on the economy and the different impact that those inflationary environments have on the wealthier classes and the lower working income working class households. And again, as I mentioned a few slides ago, go back to that meeting on Jekyll Island. Who was there? It was the big bankers. It was big bank interest, J.P. Morgan, Rockefeller interest there. And who benefits really possibly the most from these environments? Well, it's the banks. You have more and more money being created. That's more money that they can have to lend out to create loans, and that's how they make their money. They earn interest on the money they're able to lend out. More money in the money supply means more loans, means more interest payments, means higher profits for the bank. So I'll just close you with that. Thank you for your time, and thank you for listening.